All right, good morning, everybody. So before we get started today, a reminder that you have your group project due this weekend. I know a lot of the groups have started coordinating already. Make sure you respond to them. If you haven't already done so, you might get left out. That's not going to be good for your grade, so definitely recommend you follow up with the people who've been reaching out to you. And I know some of you have already communicated with me. If by the end of the day, if I haven't already told you to go ahead without the student not responding, just assume they're not going to be a part of your group. So if you have any questions about the last part, I'll be sticking around again today. Give you some time to talk and ask questions about the industry you're valuing. Any other questions that you might have, I'll be around. So today is going to be the last class we're going to be talking about new information. Next Tuesday we'll be having a review, and a week after that you have your exam. So please be prepared with questions by next Tuesday. Make sure to cover anything that you might be interested in for the exam. I'll have my what I plan to review, but not a bad idea for you to come prepared with questions too. And before we get started with the alternative filings, I just wanted to point out a mistake I made in the valuation last class. I subtracted out cash from the value of the firm that should have been added in. So just a mistake that I had made. I wanted to point that out. I also worked on a slightly cleaner version of the spreadsheet. I'll post that when I get back to my home office later today. All right, so today we're going to be talking about alternative filings. There's already a ton of information in the 10K. Why are companies bothering with reporting even more information? Right? If you go through and read the entirety of a company's 10K, you'd think that's capturing all the information that is potentially available for that company. So why would they bother with anything else? The thing is, new things, new information always comes along. So it's important that companies report that information as they receive it. And so that's basically the point of the statements that we're going to be talking about today, right? The three big ones that we've already discussed, the balance sheet, income statement, cash flow statement, that contains most of the material information, particularly at time of release when the company's reporting their quarterly or annual filing. But there still might be material information that's relevant to the company's value as the company is continuing its production, right? Things don't stay the same, and that's kind of the entire point of financial reports in the first place, is to present new information as that comes along, right? Companies can go from one of the largest, most powerful companies in the world to a bygone afterthought in a relatively short amount of time, right? So as information changes, it's important that companies are reporting that information to investors, and that's the entire point of the filings we're going to be talking about today. Also, in part, is due to regulation fair disclosure. So it is an unfortunate common history among companies that they would pick and choose who they would provide information to over time, right? So before making material information available to the public, broadly speaking, they would pick and choose analysts and investors that they might be friends with or close to, or that might give them favorable ratings, in order to benefit that person, benefit the company in exchange for information. So in the early 2000s, Reg FD was enacted that basically mandates that if a company is going to disclose information to individuals, they have to also disclose that information publicly to the rest of potential investors. Right, so the whole idea behind this is to continue full and fair disclosure and trying to get rid of this practice that companies would engage in that would privately benefit select individuals or entities. Right, so kind of in part with the Reg FD regulation was companies having to disclose more material events that occur over time between their primary financial statement deliveries through 10Ks and Qs. Right, and so keeping in line with Reg FD, companies are reporting a lot of information on a pretty frequent basis. All right, so one of the first reports that companies are going to be reporting are called an 8K, Form 8K. Basically what's going on here is that in between the quarterly filings, if something significant happens to a company, they're required to report it to investors, right? If something is going to materially affect the company, right? And what does this mean? SEC defines material affects a company as there's a substantial likelihood that a reasonable investor would consider this information important when they're making an investment decision. All right, so substantial likelihood, there is room for interpretation, but the SEC basically has breakdowns of information that they explicitly state is going to be important to investors and has to be reported in these 8K reports. All right, so what are these sections? Business and operations, right? So this seems like a very broad category, and if you go to the SEC's website, they'll break down explicit examples of what they deem as business and operations, but this is going to be something like entering into a contract with a supplier, entering into a contract with a buyer, or a previously outstanding contract dissipates, right? And so this is information that pertains to the company's core operations, right? So a good example of this is if you're, say, a defense contracting company who had a, say, 5-year established contract with the United States government, and that contract falls through, that's going to be a huge crunch, a huge deterioration of your revenues. So you have to report that information to shareholders, right? So if there's a significant change in the operations of a company, you have to report that to shareholders. Financial information, right? So this is kind of what we were talking about with the revisions last time. All financial statements are based on some sort of estimate. We don't have perfect information on all the inputs to what ends up in a 10K. So as financial information changes, it could be revised in the company's 10K. There could also be significant changes in the company's financing position in general, right? Maybe they planned on taking out a significant amount of debt in order to fund some investments, and that fell through. Or on the flip side, they engaged in significant debt issuance, and they're able to acquire additional debt more than was planned. If there's anything significant going on with securities and tradings, if they're making any issuances, companies have to report that information as well. If there's any significant change in accountants and the financial statements, if companies are well established, you shouldn't see much information in this regard, right? Typically, companies will hold on to the same auditor over very long time periods, especially once they have an established relationship, right? In many ways, because it's a matter of efficiency. When an accountant gets to understand a company, it makes it much easier for them to go through their financial statements and being able to verify the information there. If there's any significant change in the corporate governance or management, right? If the CEO steps down, CFO is appointed, stuff like that, it has to be reported. If there were any major votes from shareholders that will affect the company structure, company has to report that information as well. If they have any change in the asset-backed securities, or they fail to make a planned dividend payment, something like that, that has to be reported to shareholders. Anything that would pertain to regulation fair disclosure. So if a company is providing information to private individuals, they have to provide that same information to the rest of the public at the same time. And basically just the off category that covers everything else not already explicitly included in the previous material information events. Oh, and changes to financial statements. Right, so there's a lot of explicit examples that the SEC provides that fall into each one of these categories on what constitutes a material information event that has to be reported to the shareholders. So companies have increasingly few ways of scooting by without reporting the Form 8K. Right? And this is an important thing to consider because companies can't just sit on important information. When something new comes about, that information has to be reported to investors for public companies. Right? And as you can probably already tell, there's a lot of time, attention, and money that goes into putting together these financial reports. And that's one of the motivations for many companies to remain private. It's not uncommon for companies that might want to raise capital to choose not to just because of the very intense time and money requirements that it takes to hold up to and abide by the regulations that are required of publicly reporting companies. Right, so that's a lot of information. Companies have to stay on top of it. If they don't, they can find themselves in trouble with the SEC, fined, stuff like that. But also importantly, it can lead to investors having issues with the company. And as we'll see later on today, that can result in different changes to the firm. There are also regulations around institutional investors, right? Very often you'll see this termed smart money, basically wealthy people trading in things. And these filings are going to be through 13F filings. These have to be reported on a quarterly basis within 45 days at the end. This was based on one of the earliest regulations through the SEC in 1934. Basically, you have to report any long assets under management. Right, so by long assets means you hold on to the security itself or the obligation under the contractual arrangement of a option, something like that. All right, so what is an institutional investor? So they have to have at least 100 million under management. After that category, it's basically any entity that invests on behalf of other people. They have discretion over the investment decision. So that includes a lot of institutions, right? Banks, broker dealers that have that manage the investments themselves, companies that manage their own investment portfolios, or any individual that has discretion over others' investments. What's the information that has to be included in the 13F? Who is issuing the securities? This is basically in order of the filing, as we'll see. Who is issuing the securities? What is security actually entail? What type of security is it? How much of the security you own? What is the value of that security? Any voting rights that might be tied to that security. Right? So being long on a security doesn't necessarily mean you have voting rights. If you're investing in equity, then yeah, you're going to have some voting right. So what type of voting rights do you have? Are you sole discretion? Do you share voting rights with a parent or subsidiary? That sort of information has to be reported in the 13F filings. Also of important note are insider tradings, right? So how are executives trading? So insiders are defined as directors, officers, and beneficial owners, so people who own more than 10% of a company's equity of any publicly registered company. They're going to have to file a Form 3, which is just noting, okay, this person is now an insider and they have securities. Once you've filed a Form 3, then you're also going to be required to file Form 4s when you buy or sell securities of the company that you are an insider of. Right? And this is pretty important for investors because insiders have valuable private information, right? As you, I think, have to take investments by this time, right? Before this course, yeah. Right, so you spoke about market efficiency and the 3 levels of market efficiency. The weak form market efficiency, where asset prices themselves reflect predictability. If markets are weak form efficient, an asset's price doesn't convey information about its future performance. Interestingly, depending on the asset market you work in, there are going to be a lot of proponents for or against that sort of form of market efficiency. When the commodity brokers and traders that I've met tend to think that weak form market efficiency doesn't even exist. But evidence generally suggests that it does. Then you have semi-strong form, where you have not only the asset price, but all publicly available information. And then you have strong form market efficiency, which includes the insider's information on a company. And strong form market efficiency does not exist because insiders can consistently earn profits on any trades that they engage in for the institution that they have that insider information on. Right? So insiders can get significant returns on any trading decisions they make on companies that they have insider information on, just because of the nature of their operating in the company. So also, there's been a long history of insiders engaging in insider trading, benefiting themselves, often at the expense of shareholders. Right? Historically speaking, it's not uncommon for insiders to sell out their shares when they know a catastrophic event is going to be imminently occurring for a company. Unfortunately, we've seen the same thing with trades on our legislatures here in the country. Right? Insiders have valuable information. You can earn significant returns on that information if it's not publicly available. So their behavior can affect asset prices. Right? When an insider engages in any sort of insider trading, that is a pretty strong signal for or against a company over time. Right? Example being, if a CEO sells off their full positions in a company, that's a significant sign that the company is likely going to face some very difficult times in the near future. So the entire point of these forms, the Form 3 and Form 4, is to report who is a material insider to a company that has discretion over the company and may have significant insider information, and what sort of trades do they engage in. So the idea behind this is it has to be publicly known to investors how holders of the company are actually investing. Right? If it comes to light that insiders think that the company is going to be underperforming and they sell their shares, but they're telling investors, oh, no, everything is fine. Right? What people do with their money means a little bit more than what they say. So this is basically a good sign for, or a good reflection of what management actually think in a company. Now, that being said, it's important to keep in mind that these individuals are still investors, and it's, broadly speaking, pretty solid investment advice to have a diversified portfolio, right? So from that perspective, often executives will sell some of their shares, but typically you want to see that, especially at the chief executive level, they're holding a significant amount of their wealth within the company because their decisions are going to be significantly affecting its value. We also have activist investor trading. Right, so if an activist investor is targeting a company, that's going to be important to know. Right? And they're going to have to file a Schedule 13D that's reflecting their ownership in a company. This is contrasted with passive investing. So with passive investing, you're just it's something like the S&P 500 ETF. You're just passively investing in a company, wanting to get that return over time. With the 13D, there may be intent for some decisions to be made, for this investor to try to result in a change in the company that they're investing in, rather than just earning their return on investment. All right, so when we look at a 13D, looking at the motivation for this can be really important. Because when investors file these, you'll see a motivation section that highlights why are they engaging in this investment. All right, and one we're going to look at is going to reflect they just think the asset happens to be undervalued, and they think that this is going to generate a significant return on investment. But if they note that they think the company is underperforming and it needs a significant change in management, that can reflect that they're going to attempt something like a hostile takeover or a company breakup or something like that. And that's not uncommon. There's something that is potentially in the works at Disney right now. Right, there's been with Bob Iger retiring, coming back, the company's been significantly underperforming, and there's a couple of investors that think that this underperformance has to result in a significant shakeup in management and investment policy of the company. And ironically enough, that's how Bob Iger originally got the position a couple decades ago, because of similar activity in the firm about 20 years ago. Right, so investors don't need a majority of the company's shares in order to have significant effects. The two investors who are interested in changing Disney own about 2% of the company's shares. So only with 2%, they can leverage their vote to try to affect change by just getting other investors on their side when they're trying to make any sort of change in a company, right? People don't need a majority of the shares in order to affect change. They just need 50% plus one of the shareholders to agree with their conclusions. But any investor that owns a significant stake in a firm is capable of changing the vote for any number of the large decisions that companies have to post to shareholders, including what management is composed of, or who management is composed of. Right, so one of the most significant effects of activist investors are changes in management. Very often, the motivation for active investors are poor management performance. So, right, they'll note in their filing they think managers are underperforming, so we're going to change who is controlling the company and how exactly they are running the company. It can lead to investment policy changes, right? So using Disney as an example, Disney Plus was one of their largest investments over the last several years, and it's been losing a lot of money, right? So investors have been generally unhappy with that because this is a company that is making a lot of money with, I think, particularly its parks division, but now it got into the streaming service and it's losing money there. Right, so investment policy is one of the things they might aim to change. Maybe they'll change executive compensation. Right, executives are paid a lot of money, especially nowadays. So if they don't think that compensation is generating a return on investment for the company through that manager's decision, they might want to change the compensation, either amount or how exactly executives are compensated. And they might also just try to change the governance of the firm. Maybe they'll try to get a board seat to have additional effect on the company's policies, and be able to have access to a bit more information on the firm. All right, so we're going to turn over and look up a couple of companies and look at the filings that they have for each one of these reports. All right, so 8K, current report. After companies have filed their 10Qs, 10Ks, if any material bit of information comes up, they have to file the Form 8K. So this details what exactly has changed. All right, so if there's any significant change in operations, they have to report that as well. All right, but one of the major, the motivation for this change are changes in directors of the company. Right, so they appointed a new chief executive officer. They also appointed a new chief operating officer. So this is material relevant. This information is material relevant to investors. Right, who's running the company is going to have a large say in the future of the company. So firms have to report this information in 8Ks. Right, so you'll often see 8Ks are reported between financial statements whenever there is any of this significant information reported. All right, so next we're going to look at the 13F. So this is going to be investment reports. So you have the cover page that just gives information on who exactly is filing this information, the total portfolio value under investment, and what potential managers or basically subsidiaries of the company are in operation. So the information for the filings themselves are in the next file. And so like we talked about, it's listed in alphabetical order or numerical order since some companies start with their numbers. So it tells you what they are investing in, what type of asset, so common stock. This is information on the asset item themselves. So when companies list a publicly acquirable asset, they have to have basically these numbers that are how you can search up these companies in certain databases. Then the value of those holdings, the amount of holdings, and what type of voting rights and investment discretion does it have. So this basically means that they're sharing these investments with subsidiary managers, and then what sort of votes do they have with those management? So do they have full voting authority? Is it shared with another investor, or are they holding non-voting assets? Right. So in other words, passive ETF investments held in a particular security. All right. So this information all has to be reported by asset managers, and it also gives good information on right, what is important to investors. If it's a passively managed fund, this information doesn't provide much. Right, they're just passively investing in the open market. But if you're dealing with something like AQR, which is an actively managed fund, started, I believe, in the mid 80s, then there is some discretion over what they're investing in, how much they're investing in, and how long they're holding on to the shares for. Right, so this information is important to shareholders because shareholders can see what markets think of the asset that they're considering investing in. Right, if an active manager considers purchasing a security or is actively holding on to a security, you'll have to see that information here as a reflection of how well do market participants look at the asset that you're holding on to. One important information to keep in mind, it doesn't require short positions to be reflected here. Right, you have call and puts, so you're holding on to that option itself, but you don't necessarily have to report short positions unless you own the underlying asset and are selling it short. So if you're long a short position, it doesn't have to be reported here. And that's an important bit of information because short positions are another very strong reflection on company performance. Right? One of the ways that companies might look at the value of a firm is looking at the proportion of shares held short relative to the number of shares outstanding. And typically you can find that on something like a tear sheet, but getting detailed information on that is a little bit more difficult since companies aren't necessarily required to report those short positions, unfortunately. All right, next we have the Form 4. So when you have a change in beneficial ownership, so you have executives, directors, right? So in this case, chairman of the board and CEO, Mark Zuckerberg, what is he doing? We're looking at what security they're trading in, whether the security was acquired or disposed over in this column, and how much of the securities. Okay. So basically what this is saying here is Mark Zuckerberg sold 590 shares of Meta stock at $331. And it's basically saying that looks like it's being sold for cash for one of his foundations. Right? And this is important information for shareholders. If you see executives actively leaving a company, that might be a poor signal about the company's future performance. Right? So this is important information. Investors need to know it. How do executives treat the company? Are they fleeing ship when it's in the middle of sinking? Are they acquiring more shares? It's not uncommon to see more disposals than acquires because, right, again, if people want to actively use the cash available, they're going to have to sell the securities. All right, lastly, we're going to look at a 13D filing. All right, Carl Icahn is a, what was it, 13? He's an activist investor. So, all right. So this information is basically detailing If an activist investor is starting to acquire and they get over the threshold of being that activist investor at 5%, they have to report right, what is the investment vehicle that the investor is engaged in, how much shares they're purchasing in a given company, or convertible bonds. After you see what they're investing in, scroll down and look for purpose of the transaction, right? So why are these investors engaging in this investment? And this is where the important information starts coming out, right? So after you find what they're investing in, why are they making this investment? So these positions are acquired in the belief that shares were undervalued, right? So basically they're saying that they think the asset prices of these companies are less than their true intrinsic value, which you would get from that cash flow analysis that we started looking at last class. And if the intrinsic value of the company is less or is greater than the cost of purchasing that investment, you would want to make that investment. They would be undervalued. All right, so from there, it might give more information on whether they intend to have active involvement. And here it's basically a light touch going on, right? So they're basically just having discussions and trying to improve performance of the company. Nothing that's pointing to a significant, nothing so far that's pointing to a significant change in their effect on the company. All right. Now they look at their investment in Caesars Casino and Hotel, I believe it was. Now it gets potentially a little bit more active, right? So our brand of activism well suited for the situation, which requires new thought, new leadership, and new strategies in order to generate returns. All right, so this is suggesting that they're going to be a little bit more actively involved with this company specifically, just because it sounds like they're suggesting this company is in need of that change. So through these filings, people can see what investors are actively interested in a firm and what is the nature of that investment, right? If it is the nature of simply being undervalued, that is a beneficial sign to already existing shareholders, right? And generally, you want your asset prices to appreciate over time. So this sort of investment suggests that, right, other market participants are agreeing with you. If it's the more actively phrased sort of acquisition, that suggests that, well, this company is likely underperforming, and either these activist investors are going to make attempts to try to improve the company's operations, or the company itself is going to have to make some significant changes without them. Any questions on alternative filings? Okay. Relatively straightforward when you look at them. All right. Basically, it's important to know that information changes over time. As that information changes, public firms are required to report that information and make it available to shareholders. If companies decide they're going to report to a select few individuals, relatively new regulation requires them to report broadly to all shareholders and to markets more publicly. Right? And these forms are basically just the different ways that they can do that. 8Ks are required on the firm side because companies' performance change over time. The economic circumstances of the companies change. They're going to have to report that information. When you're dealing with insiders at a company, they're going to have to report how their tradings in the firm are potentially reflective of management's belief of the company. And then urge investors in the firm, right? So on the outside investors, investment funds themselves, you have to file the 13Fs reflecting their general holdings and 13Ds for a specific holding in a company if they become one of the large shareholders in a firm. Right? All this information is important to investors. We need this information to understand the performance of the company and what other market participants see as pros and cons for making the investment in a firm. Right? So we can use this information in addition to the financial statements that we already get out of 10Ks and Qs that are providing the larger component of our understanding for a company's performance, right? Cash flows are necessary, but there's additional information that might affect the company's future cash flows, and that information might be gleaned from these sorts of filings. All right, so if there aren't any other questions, that will be it for today. Again, next Tuesday, we're going to be going over a review, so I'll post the PowerPoint for that. If you have any questions, make sure you have them ready for Tuesday. This weekend, you have the last part of your project due. It's a group project, so you have to be working with the other people that I've reached out to. If you haven't responded, that's not going to be good for you, so definitely recommend you respond by today at the very latest. If you have any questions about your project, I'll stick around for a bit to talk about that. All right, but if there aren't any other questions, I hope you all have a good day.